Okay, so good afternoon. This is the recording class for the first class, Introduction to Liquidity and Inefficiency. So I would like to ask you, my friend, what do you think moves the market? This is the first question, the most important that I always ask. What moves the market? Okay, why does the market move? What do you think makes the market move? Okay, this is the topic. Good answer. If you said liquidity, you're on the right track. What is liquidity? Second question. Okay, so the first one is right. What moves the market? Do it like this. Okay, so the answer is liquidity. Perfect, it stops. All right, so this is liquidity, and we're going to understand liquidity further beyond of what everyone else has understood so far. Right, so liquidity will always be present in the marketplace. Okay, that is the first thing and most important because that is a good thing, right? The market will not move unless you have liquidity. And good for us, liquidity will always be present here in the marketplace, right? How can you identify liquidity? That is another important question, right? So we have two types of liquidity, right? The first one, it is presented in the form of buy stops. And to this one we call buy side liquidity, okay, by its acronym BSL, or sell stops by its acronym SLL, sell side liquidity. Right, this one right here. Good. So it will always be present in the marketplace. It is presented in the form of buy stops or buy side liquidity, or sell stops, sell side liquidity. Where can you find buy side liquidity or sell side liquidity? It will be resting above swing highs. This is your buy side liquidity, or below swing lows. And this is your sell side liquidity. Sell side liquidity. Like this. I made a little mistake here. This is SL, sell side liquidity. Resting above swing highs as your buy side liquidity, and resting below swing lows as your sell side liquidity. Okay. So just would like to ask you one more question. Of course, buy side or swing highs will be above current market price, right? That's why it's called buy side liquidity. And then sell side or swing lows will be below current market price. This is why it's called sell side liquidity. So that's pretty forward to the point. So I would like to know if you know how a swing high or a swing low looks like. It's just a draw. Draw on liquidity or magnet for price. Yes, good. So just for completeness sake, I'm going to draw here real quick. So it is a 3-candle pattern, right? That creates a candle that is higher than the other two. So Larry Williams used to call this a fractal, but he used to use it for 5 candles. So he would say that we need to see 5 of these for then to consider going to the opposite direction, right? Just like this is a climax. But then Michael J. Hoddesdon introduced a more fresh idea that you don't need to see all of that for then to expect the market to reverse or to go to the other direction. You just need 3 candles, right? And that is the pattern of a swing high. And the candle number 2 is going to be the highest of them all. So number 1 is going to be here, 2, and 3. Above this swing high, this can be on any time frame, okay? It does not matter what time frame you're looking at. You're going to have buy side liquidity resting above this swing high, meaning that anyone who was short after this swing high got formed is using this swing high to protect their buy stops or the position, their short position. So they're using this swing high as a means of protection, right? So there's going to be a lot of orders here, stops resting above this swing high. Beautiful. So this is going to be your BSL or buy side liquidity. Let me make this one bigger for you, like that. And the same thing is going to be used for sell side liquidity right here. So you have swing number one, candle number one, candle number two, and then candle number three. So this is a swing low because candle number two is the lowest of them all, lower than the candle number one, and lower than the candle number three. This one right here, your sell side liquidity. Sell side liquidity, beautiful. Right? So anyone who got long here or went long down here is going to protect their long position with sell stops below this low. Right? That's pretty much understood so far. Okay? So what is the next thing that you have to know when looking for liquidity? Right? So you already know that liquidity is going to be presented and it's going to be resting above swing highs and below swing lows, and they're going to act as draws. So this right here is going to act as a draw liquidity, or it's going to be a magnet for price. So the algorithm, if you want to believe on an algorithm, if not, it's fine. But let's just say that the market is going to seek this liquidity and is going to gravitate towards this liquidity. If we are on a sell program, it's going to go to sell side liquidity, and if we are on a buy program, it's going to gravitate towards buy side liquidity. So what is the next thing that moves the market? The next thing that moves the market is, well, I think I can do this. What is the next thing that moves the market? Oh, no, I won't do that. The next thing is inefficiency, right? So probably you have heard about this one before. What do you think an inefficiency is, my friend? Exactly. Good. That saves time. So, an inefficiency is left in price when we have displacement. So this won't always be on the marketplace unless we have displacement, right? On difference to the liquidity that we always want to find liquidity. Does not matter what price is doing. It can be a holiday where you have the first hour or so until 12 normally, which is very choppy. The market is still moving, but you might not have an inefficiency of the time frame you're looking at, but you will have always liquidity. Okay, so an inefficiency needs displacement to be created. Then it is basically a void gap. Okay, you said that one right for value gaps, or a hole in price action. Good. So what happens here? So the market will tend to return to the inefficiency or fair value gap to deliver price efficiently, basically. And this is called efficiently pricing. Bam. And this is going to act also as a magnet on a trending environment. Okay, good. So let me just put this more into the picture like this, right? So do you know how a fair value gap looks like? By the looks of it, I say that you know how it looks like, just to make sure. Yes, I know. Perfect. So it is another 3-candle pattern in which you are going to expect, if if the fair value gap or the inefficiency is going to be bullish, then you expect candle number 1, which is the low of the fair value gap or inefficiency, not touch candle number 3's low. So candle number 1's high should not be touching candle number 3's low, and that's where you have a hole or a void or a gap in price action. So we're going to use this gap right here. We're going to put nice color to it. Because it's bullish, I'm going to use the green color. Okay, and I'm going to name this one as plus fair value gap or FVG. And now, for a bearish example, I'm going to do the same thing here. Right? Candle number 1, which is now at the top, should not be touching. Candle number 3 is high. So actually what's going on is the candle number 2 is creating the gap or the void. So you do the same thing. You mark that down if you want to, or just pay attention to it if you don't want to mark it down. And then because we have been expanding lower, there's going to be a bearish fair value gap. Right? So very good. Let me just grab it like this and put it like this. Right, so far this is understood, right? Can I continue? Do you have any questions about this one? Just to make sure. Yes, I can continue, right? Or yes, you have questions. No questions so far. Perfect. So now, how can we use this? Okay, so the way we can use this is that we are going to utilize, and this is a model in and of itself, so you can already start looking for this on the chart as soon as this class finishes. Okay, you're going to have to look for liquidity as your target in the hourly chart and the 15-minute chart. This is going to be the easiest place where you're going to find liquidity. You can target that. So at the beginning, I'm going to teach you how to use liquidity as a target first. It can also be an entry, okay, but that requires more experience and understanding of price action. And then I'm going to teach you how to find inefficiencies, like this fair value gap right here, which is going to be a bullish fair value gap, as your entry. So you're going to use inefficiencies as an entry mechanism. Okay, and this is going to be found inefficiency as an entry. On the same time frame, you can use the same time frame, right? But I don't think you will enter or feel confident entering on the same time frame as you find your liquidity, because it's going to be kind of like a higher time frame in the terms of daily trading, because if you are going to be a day trader, you're not gonna want to spend the majority of the time watching at the hourly or 15, right? Unless that is part of your model, which is totally fine by me. But the majority of the people, and this is why I teach it this way, are going to spend more time on the 5 minutes and lower, right? So this is why I recommend looking for a fair value gap or an entry on the 5 minutes and 1 minute. This is where you wanna look for your inefficiency or your fair value gap to form. So right here, what you're gonna see is that we have a swing high right here, and this is going to be your buy side liquidity, right? This is your swing high, like this. Let me just a little bit to the right. Nice. And this is going to be your inefficiency. So what is going on here is because this swing high is above current market price, which is marking here at whatever time it is. So let's say it's 10:34. So at this price, you have above this current price, you have swing high right here, which is also your buy side liquidity. But this one is higher. Because this one is higher and I have these two together, I'll be aiming to the highest one. You don't need the highest one to make money, of course. You only need a move from the fair value gap, which is your entry. So let's say at this time, okay? Or better at this time. Now you have had an expansion higher towards the liquidity you're looking for, right? So what you're looking for and you're waiting for is an expansion towards the liquidity. because that is your target. It has to be in the direction first. I'm going to teach you then later how to enter based off of more things. But this is the easiest, most visual and 1, 2, 3 approach towards trading. You want to find your liquidity and target on these time frames, and you want to wait for an expansion or displacement in the direction of your liquidity. Okay, and then that expansion is going to leave your fair value gap. That fair value gap is going to be your entry. And you're going to allow price to return to that fair value gap. And that is a question I get asked a lot, right? You said there will be many fair value gaps, so which one to use for entry as per your picture? So I would teach you that later, right? Don't you worry, because it requires more practice and experience to find which fair value gap price is gonna respect or is gonna trade back to. And I actually done this a lot on live. Normally when we're on live streams, I say, okay, I want to see this fair value gap stay open, and then the market does not return to that fair value gap. And that comes with more concepts. And because this is the first class, I don't want to introduce a lot of things today. Yeah, so for backtest, I'm gonna explain to you after today's class. Don't worry. I wanna teach you how to do it. I'm gonna tell you what to look for, right? But let's say at this current price has left us a fair value gap here, so you have buy side liquidity above this high and this high. Then you wanna wait for a return back into this fair value gap. That's gonna be your entry, and then you aim towards this liquidity. So the liquidity is gonna be based on hourly, 15 minutes. You're gonna look for or wait for an expansion towards the liquidity you're targeting, and you wanna wait for a return to the fair value gap. Sometimes it just leave you one, and when that happens, it's way easier. And when you have two, let's just say, because I wanna say, let's say you have two like this, okay? You're going to allow in your entry, you wanna enter on the first one, but you have to allow your stop for the second one, because it might return to the second one and go to the target. Okay, but sometimes it might not even return to the second one. It might just touch the first one and run. Right? I know how to call this on live stream because I have to look at what price is doing, and my expectations will shift regarding the behavior and price action and some other concepts that I want to teach you on this mentorship. Right? So there's going to be a class on breakaway gaps and when to expect that fair value gap stay unfilled. But for this class, whenever you have two, you want to enter on the first one, and your stop loss should allow the second one. Below the 50% of the second one is fine, or the second one to be more secure, right? But you don't want to try to enter on the second one because sometimes it won't retrace that deep. You just come to the first one and run, right? So like that. And here, your entry will be on the 5 minutes and 1 minute towards liquidity. Good. Do you have any questions here? Any doubts before I continue explaining and then go to the charts? Because I want to send you homework also. I love sending homework. All right, good. Let's get going. So is this copied? You took a screenshot of this, or you note it down on your notebook? You can take a screenshot of this if you want. If not, this is gonna be on the YouTube video anyways. Done. Nice. So why is an inefficiency called an inefficiency? Why will the market tend to return to the inefficiency? Why is this even a thing? Why does this happen? Why this way? Why not that way? Okay, so this is the reasoning behind the inefficiency and why it works. And why do you enter an inefficiency? Because when the market is trending, okay, like this, for price to deliver itself, or for the mechanism, or for the market makers, or for the algorithm to deliver price efficiently to a level of liquidity, they will have to price, remember, just efficiently, okay? So they want to deliver price efficiently to this level of liquidity. And when they expand or have displacements like this, they're going to leave gaps in price action, which are little pools or holes in which price has not done the work or done the job, like this one right here, right? So for this reason, for price to be able to keep going higher towards this buy side liquidity level, so let's say this is a buy side liquidity level, because it is above current market price, and this is more certainly a swing high like this, okay? So for price to deliver towards this level efficiently, it has to come back and reprice to this gap. The gap starts at the low. If it's bullish, it's going to start at the low of the candle number 3. So your entry has to be below candle number 3, plus 1 tick or minus 1 tick, okay, if you're bullish, right? You don't ever want to try to finesse the entry at the 50% of the fair value gap, because you're going to miss amazing trades whenever you write. Price won't touch the 50%, okay? This is a nice gem for you and for your notes. You want to enter at the higher quadrant of the fair value gap. And I'm already getting a little bit too deep into this, but this is the 50%, okay? So you want to enter above the 50%. The best one to enter is going to be just 1 tick below the candle number 3 right here. Okay, price is going to kiss that and just run, right? So basically, you want to enter in this area right here, right? So price is inefficient in this little area because it has delivered buy side and buy side only in this candle number 2. Okay, this is going to be a bullish candle. Candle number 2 is bullish, so it has only delivered to the upside or buy side. So for this candle to be efficiently delivered, it has to return price lower to deliver sell side into this buy side, into the candle number 2's buy side. So like this. And this is why now that it has done that, now it has delivered all of this price efficiently, it can continue going higher, right? So this is why inefficiencies work. This is why price will return to inefficiencies, and this is the only two things that move the marketplace. It is going from liquidity to inefficiency, or from inefficiency to liquidity. And whenever it's not doing that, price is consolidating. Then you're gonna see the target being hit. Okay, any more questions about this one before I jump to the charts? No, good. So this is how my chart looks like. All right. And on Wednesday, I was calling these higher prices. Okay. So this is the ES, by the way. So I'm just going to use the ES for today's lesson. And you have a swing high, swing high here and swing high here, right? So at the time that I was streaming, okay, note how I'm looking for this liquidity on the 1 hour. Okay, so at this time I was streaming, the market price was down here, below where this sell side liquidity. So we had already taken out sell side liquidity at the time I was streaming. And I looked at these swing highs here, and if you go to the 15 minutes, they are also here. Okay, the same swing highs here and here. The price has not changed. It's going to be the same one in all time frames. Then once I identify the liquidity, I go lower to the 5 minutes, and I just look for something. Okay, now I look for an expansion in the direction of the liquidity I'm targeting, which is these highs right here. And do you have a fair value gap in that? So you have the first one here. Okay, this is your first fair value gap, and then you have another one here. This is your second fair value gap. So this is what I was talking about, right? You want to enter on the second one, the highest one. Sometimes it won't allow you this one, and that is okay. That is actually what you want to see, because if price don't make a deep retracement towards the first fair value gap formed in the expansion higher, that means it's super bullish. That is good. You want to see that. Okay. price returns into this fair value gap right here, which is candle number 1's high and candle number 3 is low. They have not been met. Let me put it like this. It's gonna be more visible. Your entry has to be below candle number 3's low plus minus 1 tick, and then you see nice expansion higher. Right? What if you miss that one? Then you have another fair value gap here. Okay. So remember, the fair value gap is the 3 candle pattern right here. Right? So these 3 candles make the fair value gap, but the fair value gap is gonna be formed in candle number 2. So you have price return to this fair value gap, nice expansion higher. It comes all the way down here one more time before running higher. To take out anyone who may be trading their stop losses to this swing low. This is already sell side liquidity, right? So the market takes them out before continuing going higher. And then you have another fair value gap right here in the same direction. So remember, the target has not been met yet. The target is still here intact. So as long as the target is intact, you still have chances. If you missed an opportunity. Value gap right here. So you see price coming to that fair value gap here, spending some time in there. But then when time is right, it just pulls higher with speed and magnitude through those highs. On the 15-minute and on the hour is going to be the same, right? This is on the 5-minute. So now, if you were looking at the 1-minute, because I know most of you guys like to look at the 1-minute a lot, especially on the Nasdaq, because you like the speed and volatility. So this one right here is expansion in the direction. After taking this sell side liquidity, you have the expansion in the direction of the liquidity, right? Which is all the way up here. Remember, you don't need that one to make money. You can only aim towards something here, right? But in the beginning stages, you don't want to push yourself too hard. And you just want to know how it works. You want to repeatedly see in the marketplace fair value gaps delivering. So expansion towards the liquidity up there. Have this bullish fair value gap. And you see price returning here, spending some time, just like the example we saw in the 5-minute. Okay, this is going to repeat a lot. And then nice expansion. If you miss this one, you want to see another one right here. And this is the first fair value gap and only in this price deck, right? Just like this one. From this swing low to this swing high, this is the only fair value gap on this price deck expansion higher. From this swing low to that swing to that swing high, this is the only fair value gap on this expansion higher. So price respect that beautifully, and then leave you another tiny fair value gap here. Continuation, and then it leaves you in this expansion higher. This fair value gap here, then retraces back to this fair value gap because this candle has only delivered buy side delivery, not sell side, so it needs to be delivered to the sell side also for the smart money traders to enter here. So other traders will think this is head and shoulders pattern. Shoulder, head, another shoulder, we want to break lower. And that is not the case. We don't trade patterns, we trade logic. Price keeps expanding higher, you have another fair value gap here. Price overshoots this one by a little bit, back and forth, and then another expansion higher, leaving you with another fair value gap. So you want to see this a lot, and you want to train your brain to seeing them. And you can see this one as well. So they will always be formed during expansions. So the homework for you is going to be identify liquidity on the hourly time frame or the 15-minute, and then you can find an entry on the 5-minute or the 1-minute. So in this case, I'm going to use the 5-minute, and let's say I like this one as my entry because let's say I have time to trade during the PM, so I'm not going to be on the charts during the AM because of my job or etc. So my time of trading is going to be after 12. Okay, so I'm going to look for an expansion towards the liquidity that has not been met yet. And now I'm going to look for an entry here. Candle number 3 is low, below a tick or so. And then my stop loss is going to be below this candle number 1 that creates a fair value gap. Okay, and then my take profit is going to be here or end here. and you're gonna take a screenshot of that and send it to the homework channel here on the Discord. And if you have any questions, any doubts, and please, please don't forget to enter the time of your entry. That is super important. So this one right here is going to be the time of your entry, right? The first candle that touches the fair value gap took place at 2:35. So you type that and put it like this. And if you had any news that day, you can also paste the calendar here. And that will be the entry. And the target being met. But you don't take this trade. You backtest it. So the homework is to backtest trades. Okay, is that understood? Do you have any questions, any doubts before I leave my my friend hop into the call and share his screen?
Press. So what we're gonna do with me every day, we're gonna do trade review of the trade of the day. I don't know if you wanna trade like me, maybe yes. Maybe not. I don't know, to be honest. But like I see, like what I do is I do trade review, explain my trades, what I take, what I'm looking for, my confluences, etc., the step by step. So if you wanna trade like me, you're gonna understand how I trade. Okay? Did you understand? Okay. So tell me, Pras, are you profitable or not yet? All right. No, no problem, no problem. It's it's part of the process. By the way, what concepts do you use? Do you use ICT also or not? Oh, I understand. Yeah, you have to have time on chart practice. Then you're gonna understand the market. So alright, let's do the trade review. I'm gonna do the trade review of yesterday because the trade of today was really small. Just like let me see. This trade was only 200 ticks, so this is really small for me. So I'm gonna do the trade review of yesterday. Okay. For example, FBG liquidity and movement is hard for me to identify in live. You have to spend time on try to take trades on practice account, paper trading on your trading view. Try to take trades. Okay. By the way, if you want, you can do backtesting because I spend many time on backtesting to understand the market. I literally finish my classes or whatever I'm doing, and I go to backtesting when I was a student, of course. Right now, I have many experience on charts. I take better trades, but sometimes I also do backtesting because I'm still improving my way of trading. I'm looking for perfection. I'm looking for better trades. So yeah, let's do the trade review, okay? So basically, my step by step, if you want, understand, my step by step is the first step in big time frame, in big time frame, 15 minutes or above. In 15 minutes or above, I consider 15 minutes or above 1 hour candle, 4 hours candle, daily candle, weekly candle, whatever you want. Sometimes I use weekly candle like my confluencer. So in big time frame, 15 minutes or above, look for the important confluencer. In big time frame, 15 minutes or above, look for the important confluencer. That's the first step. The second one, in lower time frame, 15 minutes or below, 5 minutes, 1 minute, whatever you want, look for plus confluences. Something more for your trade, something plus for your trade, for your analysis. The third step is in lower time frame, lower time frame, 1 minute or below. I don't trade five minutes time frame or something else. I just trade 1 minute or 15 seconds or 5 seconds or 1 second time frame. So in lower time frame, 1 minute or below, look for change of structure, confirmations, confirm, confirm, confirmations, entries. So this is my step by step. If you want to take a screenshot of this is my step by step. Big time frame 50 minutes or above, look for important confluences. In lower time frame 15 minutes or below, look for plus confluences. And the third step, the important one, in lower time frame 1 minute or below, look for change of structure, confirmations, and entries. So okay, that's the step by step of my way of trading. So I don't trade models. Yeah. ¿Estás grabando, boludo? I think yes. Let me see. Si sigues grabando. Yeah, I think this is still recording because he told me don't put music because this is recorded. So yeah, I think yes. Okay, so this is the step by step. I'm gonna delete. Okay. Okay. So alright. For this trade, my important confluence in 1 hour time frame was this high. So I'm looking for the market have a reaction in this high. Okay. This is my first confluence. We have liquidity right here. Okay. Do you see this one right here? All right. So in 1 hour time frame, we have that high as my confluence. So in 15 minutes time frame, we have liquidity. We have one high, two highs, and three highs. So we have liquidity above these highs. So in 15 minutes we have that. In 5 minutes we also have that liquidity above in that highs. In 1 minute time frame we have the same thing, liquidity above that highs. And I take this trade on 15 seconds time frame, I think. 15 seconds time frame. Right here. By the way, I don't know if you see I use completed zones as my confluence. I don't know if you see when I post my trades on Topstock. I don't know if you are on Topstock to be honest. But I use something I call it. Oh shit, give me a second. I use something I call it Cicera completed zones. So yeah, I'm gonna talk about with you about that. What's that? That is something I developed. Basically, completed zones means zones in the market that don't have to come back. You understand? It's like, oh, right here we have something. Right here we have something. So the market don't have to come back for this. Only have to come back for this. Something like that. In a quick example. So that is my important. No, well, not my important, but something important on my way of trading. But I don't gonna talk about that right now. I'm gonna talk about that when you get another topic. When you get one important topic is the third one, the number three, the number three topic. I'm gonna talk about that because completed zones is advanced. So you have to understand first the number three topic, okay? But yeah, I just let you know we have something I call it completed zones because sometimes my trades are with completed zones. So right now we have, like I told you, we have liquidity above this high. So right now we have liquidity. By the way, we have a reaction right here. So what do we have right here? What is this candle? No, no. Oh, yeah, that's bullish. Yeah, but I mean, what do you know? What is this candle? What does it mean? This candle? This white candle is an order block. Yeah. So I use. Yeah, I think you know this is an order block. So yeah, I use this candle like my order block. So I just gonna wait for the market. Like I told you, like you see, we have in 15 seconds. We are in 15 seconds time frame. So I just gonna wait for the market give me a change of structure. So right here, I don't wait for a change of structure. Why? Because for a change of structure, I gonna wait for the market make something like this and close below the past low. So right here, I don't wait for the market close below the past low because the past low is this one right here or this one right here. I don't wait for that. But why? Because I trust this analysis, and sometimes if you trust your analysis, you just have to put your limit order, your stop loss, and all of the stuff. So I just put my limit order in the 0.5% of the order block because I have an internal change of structure. High, low, high, low, high, low, high, and this high take this liquidity. So I see the market probably gonna have a change of structure. So I trust this analysis, but you don't have to do that, okay? You always have to wait for confirmations and confluences. In the next trade, I'm gonna explain you a trade with confirmations and confluences. But yeah, basically in this trade, I take the limit order in the 0.5% of the order block. Okay. So I close two contracts in one risk, 20 reward, and the last one are closed some profits. So this is basically the trade. Do you have any questions so far about this trade? Or no questions? 15 seconds is very small, so don't wait for proper change of structure. Yeah, you have to wait for a change of structure. But like I told you, I don't wait for a change of structure right here. I'm gonna show you a change of structure in the next example. Yeah, but by the way, you don't have. I don't know if you are advanced on trading. Maybe yes, maybe not. But if you're gonna learn from us, you don't have to trade 15 seconds. You first have to understand 1 minute time frame. Take trades on 1 minute time frame, and then you're gonna try to understand 15 seconds. And then when you say, "Oh, I'm good with 15 seconds," I'm gonna change to 5 seconds. Why I say this? Because it's really fast. That happen really fast. So if you don't understand, if you don't think fast, you're gonna do a bad analysis and you're gonna lose. All right. So yeah, no questions about this trade. I'm gonna continue with the next one. All right. So the next trade was this one right here. Right here is the trade. So basically, for this trade, we have in 1 hour time frame, we have this order block. So do you see this black candle? This one right here. So, oh, by the way, do you know smart money concepts or not? So basically, yeah, basically, smart money concepts say if you're looking for longs, you have to wait for the market have a reaction in the 0.5%. You have to look for discount, right? So I use Gangbox in all of my confluences. Okay, so I use the same thing. Oh, by the way, you have to know I don't use the wicks of the order blocks. I know it's a rule you have to use the wicks, but I don't use the wicks. I use the bodies. So you see how I put my Gangbox in the only in the body. Okay, so you see how the market have a reaction to the dick in the 0.5%. Literally go test the 0.5% and have a rejection. So that is my first confluencer in 1 hour time frame. Okay. in 15 minutes time frame, let me delete this one right here. In 15 minutes time frame, we have this big wick. Do you know wicks also are like a gaps or FVGs? Do you know that? So yeah, I use this wick like my confluence. So I put my gang box. I have to wait for the market respect the 0.5%, nothing close below. So you see nothing close below the 0.5%. Did you see that? You see that, right? Nothing close below the 0.5% of this big wick. Yes? Do you see that? No? So yeah, basically, this is my confirmations. When the market have a reaction, the market leave me a rejection block. This is my rejection block. You see right here, right? My rejection block right here. A rejection block is a candle like this. When the market have a reaction in something in some specific point, the market do something like this, like two candles together. This is a rejection block. Let me show you another example. This is another rejection block. These both candles maybe is a reaction in something important. You see, this market is taking the market is taking liquidity of this low, so the market leave a rejection block. So this is a rejection block. Let's see if the market leave a reaction. You see, the market leave a reaction right here. Why I say the market have a reaction? Because in lower time frame, let me say, have a retracement right here. But you have to understand, you have to see the rejection blocks. You have to see when it works, when it doesn't works, all right? So yeah, but basically this is my rejection block. Did you see this? Let me right here. So how I know this rejection block gonna work? How I know that doesn't that the market gonna respect that rejection block when I see the market reject that or that rejection block? So right here, you see in lower time frame how the market literally have a reaction to the tick. Literally, the market enter, make a kiss in an example, and then have a change of structure immediately. So that is how you know the market have a reaction in a rejection block. Okay. So right here we have a change of structure. So a change of structure, change of structure is a high, a low, a high, a low, a high, a low, and then a new high above that high, right? You know that is a change of structure. Yeah. But by the way, you have to understand the market structure because sometimes we have different change of structure, something like this. The market is taking this high and then do something different. So if you say, oh, this is a change of structure for longs, I'm gonna put my limit order right here, stop loss right here, you're gonna get a stop it out. Because something probably this is another change of structure, an internal structure. So you're gonna get stop loss. You have to understand that. We're gonna talk about that and you're gonna see that, okay? But this is example. Yes, that's very hard. Yeah, yeah. No, you're gonna understand that. I understand change of structures. That's what I get snipes like this. So all right, I'm gonna explain this trade. So basically, right here we have a low, a neo low, and we have one high, two highs, and three highs. So this is the high number one. All right, pay attention. This is brush. This is the high number one. This is the high number two. This is the high number three. Which one is the important one? The number one, the number two, or the number three? This one right here? Yes, you're right. This one right here is the important one because this is the most high. When I taking this low, right? I taking this low from my past low. So this high is the important one because this is the change of structure from the low. Oh shit. From the low to the high. So this is my important low and this is my important high. But we have an internal high right here. Do you see that? So this is the important one for take an entry. Why? Because this is the most closest for your trade, for your analysis. So this for this trade is the important one because when the market close above that high, that is a change of structure. So right now, let's see. We have a EFBG. You see this EFBG? This one right here, this white box. So when the market close above, you see how the market have a reaction to the tick in the EFBG? Do you see that? Literally, the market have a retest to the tick. So smart money concepts talk about you always have to wait for the market have a reaction into 0.5%. So what the market should have to do? The market should have to have a reaction something like this, below the 0.5% of the EFBG, right? But the market don't do that. Why? Because the market gonna have an immediately reaction. You know what is an immediately reaction or not? Clase a las 6. Sí, boludo. Sí, te mandé la lista. Dale acceso. Oh, pero estás regrabando pantalla, ¿no? Verga. ¿A quién le tocaba a las 6? Eh, Déjale escribo al rey. Igual no de responder todavía. Class. Siempre se demora en responder. Así que no te preocupes. Yo te digo cuando me responda. So yeah, literally immediately reaction means literally touch and go. But what immediately reaction means? An immediately reaction means the market gonna have volatility. The market gonna have a fast reaction. No mames si respondió rápido. Eh, y la grabación de pantalla, boludo. Estás en... le digo que estoy prendiendo mi compu. I'm turning on my PC. So, all right. So yeah, basically immediately reaction means that the market gonna have a touch really fast and then an expansion. Do you see that? So when I see this, this is my first confirmation. All right. So now when the market close above this high, what I have here, I have this FBG. So I put my limit order in the 0.5% of the FBG right here. Do you see that? The market have a reaction to the tick. Did you see? And guess what? The market don't take my order. I literally, hijo de puta, I literally put my limit order in the 0.5%, but the market don't take my order. The market was, my limit order was literally right here, but the market don't do that. So when I see that, I have to take a re-entry. So what else I have? Yeah, I know that. I know that. So we have an EFVG. So I'm gonna wait for the market close above that EFVG. So when the market close above that EFVG, I put my limit order in the top of the EFVG. Stop loss below this EFVG. Why below? Because this is not tested. Smart money concepts say you have to wait for a reaction in the 0.5%, right? So we have to the tick. So I don't like this immediately reaction. I think the market probably gonna have a retest in this EFBG. So I put my stop loss below the EFBG, and you see the market have a high, an expansion, and by the way, the market have a retest in the EFBG. So I have a good decision. So I close my contracts right here in this high. I don't know what I have here. I have liquidity probably, but yeah, I close my contracts. This was one risk, 13 reward. So this is a change of structure. I wait for a change of structure right here. I explain the change of structure. Why I use this high and not this one right here? But yeah, the important high is this one right here. All right. So do you have any questions so far about this trade before I finish the class because we have another one? All right. So no questions about nothing. Did you understand all in this class today? Boludo. Ya, boludo, cámbiate la voz.
Brian Myers.